Hi, everyone. Welcome to the 123rd episode of the Timing Research Show, January 30th, 2017. My name is David Kosmeter. I'm the creator of Timing Research, and today we will be discussing the 175th weekly report. If you haven't had a chance to take a look at this yet, just go to TimingResearch.com/reports, and you can download this or any of the past reports there. Buckley is back to moderate today, so I'm going to go ahead and turn it over to him.
Thanks, David. I appreciate it. Good to be back, especially after hosting last week. I got to take a victory lap, man. Out of the 500-pound head traders you had on last week, 4 of them said the market was going to implode and roll over and everything like that. And the 5th one said, of course, he got to go last since he was the host. All of them were wrong, and the market was not only going to go up, it was going to have a rip-your-face-off rally. So that would be yours truly out of the park. So, having said that, thanks for having me back. Let's see if I can do a repeat. Another good panel lined up for this week. John Netto from Protein Trader, Glenn Thompson from Pacific Trading Academy, and Doc getting airborne in the Cessna 172. We were talking about him starting to become a pilot. And from Theo Trade, and AJ Brown from Trading Trainer. So, guys, we're going to keep that order all day, that batting order. Let's do a quick 1 minute, 2 minute executive summary. John, kicking off with you about your trading background and what you're doing at Protein Trader.
Great. It's great to be here. Thanks for having me. My name is John Netto. I'm a high velocity cross asset class trader. I trade 99% of what I trade are futures markets. I run a number of discretionary and algorithmic systems. I'm also author of the book, The Global Macro Edge, Maximizing Return per Unit of Risk. And I take a return per unit of risk process and looking at the markets, assessing the trades, and assessing the macro narrative. And it's great to be here. Thank you.
Wow. I tried to write most of that down, John. I'm going to have to high velocity cross asset trader. Holy crap. All right. Well, can't wait to pick your brain, man, with what's going on. Glenn, over to you, my friend.
Sure. Glad to be here once again. Been trading for over 30 years now. I've been teaching with Pacific Trading Academy and coaching other traders since the beginning, which was been going back now 17 years, primarily doing technical analysis and in my own accounts, for the most part, trading the S&P, and I do a lot of Forex in the last few years in particular. So, yeah. And awesome. I do some options longer term, but yeah, primarily the underlying markets on the S&P, the stock indices, and Forex currency pairs.
Roger that, Glenn. And Doc, over to you, my friend.
It's good to see you again. Hello, everybody out there. Doc Severson here. I'm with Theo Trade. We've been around for about a year now. I've been teaching traders for about 12 years now. I've been trading for about 20, and primarily working with options, futures, and also the whole mindset game of things, understanding how to set up a professional mindset for trading success, which was my book, Hacking the Holy Grail, which came about 18 months ago. So back to you, Whiz.
Hacking the Holy Grail. Doc, I need an autographed copy of that one, man. That sounds good. Okay, so welcome aboard, Doc and AJ.
Hi, thanks for having me back. I've been trading since about 1997. And Open Trading Trainer in 2003. We've been focused on doing equity options and not necessarily learning so much the option strategies first, but rather pattern recognition first, and then matching the correct strategies to the patterns that we identify, rather than trying to force the market to fit what you know as far as an option strategy. So really focused on doing the correct process, the correct order of things, and also to not get wrapped up so much in the things that would impress people at cocktail parties, but instead the things that put profit in your pocket.
Profit in your pocket would definitely impress people at cocktail parties. So that's that's good. AJ, where are you calling in from?
I'm actually based right now in Washington, D.C., but the office for Trading Trainer is out of Fort Collins, Colorado.
Oh, okay. I was going to say it looks like a rugged office, and that looks like you in the back corner there hauling a giant sequoia up a mountain or something.
Yeah, I definitely like to participate in those Spartan races that happen periodically.
Oh, awesome. Okay, good. Well, welcome aboard, AJ, and let's get started. So, gents, we'll for all the listeners, David has or he'll get the timing research report up in his little window, but we'll start with John and we'll go all the way down to AJ. John, first question. We'll kind of mix them all together because we all kind of fumble through these. First, where do you think the S&P is going to end up by the close on Friday compared to the open today? Higher or lower, and lay us on some sort of certainty, or I guess the flip side of that trade would be uncertainty. And then we'll get in. Exactly, give us all that stuff, and then we'll get into the whys next time around.
Sure. 2264 is the number of the S&P futures I want to tattoo into my arm, because that's basically, the area we've traversed not only this month but the last month as well. Because because I have, and I know we'll get into the whys later, but the S&P's down 20 points right now, and we're doing this from the close of Friday, right?
Yes.
From the open today. Okay, so we're going to be down. I have a 20-point advantage. The average weekly range in the S&P has been about 20 points. We're actually down the average weekly range right now. Whatever I thought I was going to say last night, I have to change because of real-time information right now, so we're going to be down. At this, 2264 is my call.
Wow, 2264. Okay, and what's your delta on that? What's your certainty?
80%.
Nice. Okay,
but I have the benefit of hindsight. I mean, like, I'm making a call from a close. That's gonna be down 19 right now, and that's the average weekly range. And I have the benefit of hindsight to make this call. I mean, this is more of a math exercise than a great call on my part.
Aha. All right. When we come back around, John, maybe because we can screen share and show our stuff, maybe you can show some of the viewers where you where you get some of that stuff. That would be awesome. I'd like to see it too, obviously.
Sure.
Glenn, how about you, my friend? Higher or lower by Friday's close, and what's your delta?
Now the question is between today and this coming Friday, the 3rd, right?
Yep. Opening bell.
I heard John say
closing bell.
Okay, I'm curious, and I got a number right before I tuned in, 2268, roughly the current front month S&P. I'm not looking at my screen now, but here I just changed about 10 minutes before I signed on with you guys my forecast for this coming Friday. I was going to say we were going to be lower. I'm going to change it. I'm going to go out on a limb and say we're going to be higher, and I'm going to trust in my data. I'm going to be purely literal and objectively buy into what the confluence of everything I'm looking at is saying. And primarily, as I mentioned in my little intro, I said I'm a technician. As a subset of that, I place a lot of emphasis in terms of what I expect markets to do and how they're going to do it based on my market timing. So as it turns out, I've got a time window of between today, the 30th, and February 1st, which is this Wednesday, kind of a 2.5-3 day window where I'm expecting change. That's the significance of the window. So I said that to say, as the market fell into today's trade, I'm expecting a reversal. And as such, that would suggest, and my next time point, coordinating that with when I expect the market to change the next time, is not until the end of March 29. So from that global or time frame period standpoint, I would, interpreting the data on the face value, I would say by this Friday, I'm going to say higher, but I'll give that about a 65, between 65, 70, say 67% probability.
67. All right. So we got a lower, we got a higher. Doc, are you going to break the tie here?
I will break the tie, guaranteed to break the tie, right? So I'm going to be going down 2% by the end of this week. So cash S&P, I would say is going to be around the 2250 area, 2250, 2254. I think ultimately we'll end up down about 3%, and that's going to be the bottom of the range short term.
I think that you might be muted.
Lost the.
That's me. Sorry about that, guys.
Okay.
The mute button was in a not a good place there. Doc, coming off the turnbuckle for the tiebreaker there, man, 2 to 3%. What's your delta? What's your confidence in that?
Confidence would be about 2/3 of 67%.
Wow. Matching Glenn 67%. Wow. Now, if you'd gone 68%, I would have been worried. All right, AJ, take us home then.
Well, I'm going to bring it back to a tie, and that's changing again, like a lot of these folks, based on what I've seen today. I call it an external stochastic shock or a transient external stochastic shock. I was going to say lower. Now I'm changing it to higher, although I think it's going to be in a very tight range. And that's simply because of the technical rebound to what's happening today that I expect. But in the, say, for instance, 2 or 3 week period, I do expect a pullback, just as Doc said, but I think that we're going to get a technical bounce. And I think that there's some uncertainty based on whatever comes out of the Fed meeting. So my delta, as you're about to ask me, is probably also around, maybe a little bit lower, around 60%.
All right, so AJ's a 60%, but you're a higher, okay? Now, one of the great things about getting the hostess is going last and telling you that half of you are absolutely wrong. So anyway, I would have told you on Friday afternoon that the market was absolutely going to close next Friday lower. To the certainty, if you can see my screen here, on Friday afternoon, we did a weekly options live trade brief selling an SPX bear call spread. Speaking of that, selling 15 of Friday's 2305s and buying the 2310s as a hedge. Looking at those numbers today, it's like, oh my God, man. And we brought in, what was that, a $1.30 or something like that. And let me, what were the metrics on this? Let me bring that up. Can you guys still see that?
Nope, we see you.
Okay, no, let me.
Whiz.
Well, that's not a pleasant sight. Again, sorry. Run on the beach. Just so the retail traders understand, most professional traders either go get a tin sandwich for lunch or go work out.
There we go.
Amateurs trade during lunch. So anyway, here's the trade. Here was my delta that the market was going to be down about a 64%, and this trade's probably at about 50 cents or 40 cents right now. So to all my members, we usually do a weekly options live trade brief every Monday at 1. So I directed all my members into here. So a little bit of a trade alert for you guys, so I don't have to send out a text. I close this trade and take the $1,200-$1,300 profit on it. Now, that was a very long-winded answer to, I think the market's up by Friday. So, and we'll get into why. I think we're way oversold here. That's a little bit of a why, but if you ask me on Friday afternoon, we're going to be down. One of the reasons we don't trade weekly options over a weekend is behind me on the TV. Anything can happen. So I just think we're oversold here. I think we're up by Friday based on Monday's open here, and I'm going to go with a 90% delta, and I'm going to be looking to put on a S&P 500 bull put spread, hopefully when we wrap this up. So that's the benefit of being the host, is going last and saying all that stuff. So John, let's get back to you, man. Let's pick your brain. Maybe you can share your screen and give us some of the background on why you were saying we might see a little bit of a down this week with an 80% probability. Yeah,
I think we both answered, even though you said yes and you said up, I said down. We're answering different questions, and I apologize for the lack of semantics with this, but I was basing my answer, and I asked this, and the thing, I was a little confused, admittedly, from Friday's close.
Got it. I'm sorry. Yeah, Glenn picked that up.
Yeah, yep. That's what I got confused on that too. That's why I had to. Yeah.
Yeah, good catch, Glenn.
Yeah. So my response, in all fairness, was that with a market that's down its weekly range, okay, to this day, you know what I mean, and an S&P that's average a net change of 3.5, 4 points a day so far in January. All right, I mean, it's been up and it's been grinding, but the idea that now that we're down almost our weekly range, and I have the benefit of Friday's close, and we're already down 18 points, 19 points in the day. The answer is it's pretty deterministic in terms of which way I would go.
Well,
all right?
I will allow the honorable gentleman from where are you from, John?
Las Vegas, Nevada, sir.
The honorable gentleman from Las Vegas to extend and revise his remarks. So why don't you take a little a lap through again what you think, how we're going to do based on the open this morning, the Friday's close. So there you go.
Absolutely no. So I say now higher by 60% from the open this morning. And a couple of factors as to why that's the case. One, we are an uptrending market. There's a lot of people who are still left out of this market, and they're looking to provide liquidity and take long exposure. Okay, I think that the Fed meeting we have on Wednesday has a chance to to relieve some doubts, because there is a 30% right now priced by the FOMC of a hike in March. I think that given what we saw over this weekend, that's actually going to cause a little bit more of a dovish language, or a couple of factors in this FOMC statement that people thought might come out, but I think the Fed's going to hold off on now, given some of the headline risks that Donald Trump's presidency presents. The first is what the Fed would do with reinvestments right now. As it stands, the last paragraph of the Fed statement talks about how they're reinvesting in securities, and there was some thought that maybe the Fed would curtail that activity sooner, which would put pressure on the yield curve. It would ultimately be dollar bullish, which could send the S&P lower. I think given the events of this weekend, the Fed's going to refrain from updating that language and providing too much specificity as far as what happens in the March meeting. So if you factor in a Wednesday dovish meeting, and I do think the economic data is turning. We have ADP number coming out on Wednesday. We have non-farm payrolls coming out on Friday. We also have ISM number. I think the economic data has turned over the last 2 months. I think that data probably comes in stronger this week. There's a 2/3 chance that overall hard data, we have survey data out there and we have hard data out there. We're dealing a week of hard data. Survey data is more like the ISM, which we do have one of those, but ADP, that's in essence what measures the private payrolls, non-farm payrolls, which comes on Friday, average hourly earnings, any past revisions. I think this week is setting up to be very conducive for economic growth, and good economic growth right now is actually conducive for the S&P. So when you factor in a moderate to dovish statement from the Fed and stronger economic data, and the fact that we are in an uptrend and we have a pullback from the open price, I think we're heading higher, and that's why I give it that probability and that respective delta. Whiz.
I like all of that. Whoa. Voice of God. That was awesome, man. And I have a couple notes. I'm going to ask you a couple follow-up questions in a little bit. But let's go over to Glenn. What are you seeing on your radar? John did a nice job of mapping out a lot of things that are on the radar. What's on your radar that impacts your, hey, man, this is going to go up, and I'm throwing 67% out there?
Sure. Going back to kind of what I inferred in the previous response, just a literal interpretation of the chart and the data that the numbers are telling me. The high we've seen in the front month S&P again fell short of my projected target, which is 2316, a March contract. So we came close, but I'm going to stick to the numbers. I'm a technician, but that's not to say that I don't take into account data or information that's released. I don't think much is the meeting this Wednesday with the Fed is pretty. I'm not reading too much into that. I'm pretty certain. I'm even more certain than John that the Fed will be raising rates in the middle of March. Curiously, I've got a time point for the U.S. currency, the dollar, the day before the meeting starts. 314. So more or less, I expect the dollar, which I think is in a corrective mode right now. It's in a correction. I expect it will fall into the middle of March and then rise in response to a rate hike that we're going to see. So I mentioned that because all of these markets are intercorrelated. So the most significant piece of information, I guess, coming out this week that I'm anticipating is the non-farm payroll on Friday. And then if I take into account the reason fundamentally or reasons why I would expect, and this is tying in, I guess, to a later question, but the markets, the equity sector's disenchantment with, I guess, the immigration situation with the president. But I think that'll die out by the middle of the week, and we'll be rebounding by going into the end of the week. So,
Glenn, let me ask you a follow-up question because you mentioned the Fed a couple times, and it's incredible to me. If you hopped in a time machine, we went back a year or two or three. Fed meetings. I remember giving a speech to some Bank of America Merrill Lynch financial advisors. We actually stopped the keynote to go watch Bernanke announce whether he was going to taper or not. So these Fed meetings have gone from being these massive events to maybe a little bit of a non-event. With the non-farm payroll, are we in or out of bizarro market? Let me tell you what I call bizarro market. Remember back, maybe a year ago, good news was good news. If we got a good jobs report, it was good news. Bad news was good news, and awful news was phenomenal news because that meant the Fed ain't going anywhere. They're going to keep smoking, give us the hopium and low interest rates. Do you think the jobs report still has the same impact that it used to, it seems like a millennia ago?
My answer is I don't know, because I'm not nuanced in how I keep track of that. Again, that's where, when I say I'm not a fundamentalist, I don't pay attention to that. I peripherally monitor it, but I can give you my thought, kind of as by extrapolating on what you just said. Good news, bad news, how the market perceives it. What I do know with a certainty, just based on observation over the years, uncertain news, markets hate or cannot, that's anathema to the market. So whenever there's uncertainty, we're going to see pressure, and we're going to see the stock market being offered down. So I don't think we have that this week. I think we'll have some definite numbers coming out. I don't think, again, I'm not placing that much emphasis on the policy get together by Janet Yellen and company this in the middle of the week. I think the hard data of significance, I think that'll just be another equivocation by the bank, alluding to what's coming in March. And again, I'd give it about a 50-60% in probability for a hike then. So that's the significant thing. What we're going to see now are just harbingers pointing to that, and all signs are colliding. We're seeing a confluence of fundamentals, I expect, that are going to bear out the technicals. 2316 is the number in the stock market that I see, and I'm achieving that by a few different methods or pathways. So I have confidence in that. Okay. More to the point is the timing. A market's not going to do what it's going to do unless and until its time has come. We're at a turn point now. My next one, again, is not until the end of March, and I think that's consistent with higher prices now. So, again, I expect this little pullback we've seen since the end of last week to where we are at this moment is a knee-jerk kind of visceral response to the perception by the retail crowd out there as to the immigration stuff that over the, between the end of the last week and now. And I think we'll get over that, and the market will focus more on the hard data by the end of the week.
Correct.
And it'll be price supportive, I expect. Yeah.
Yeah, and that's what's fun. That's why I've changed. A lot of our retail listeners might be like, "What are you guys saying? The market should implode this week? This is nuts." The market has the attention span of a tsetse fly and a news anchor. It doesn't like instability, but by Wednesday, this will be an old story. We'll be talking about something else the guy's doing. So that's why I'm a little bullish. So Doc and AJ, maybe you guys could jump on my jobs thing as well. But give us your Doc, starting with you. What are some of the things you're looking at throughout the week that support your 2 to 3% to the downside with your 67% delta?
Well, first of all, I'm a technician, and to me, the narrative tends to fit what the market wants. So I'm always trying to figure out what the market wants, and I'm not trying to fit it in based on news or what I expect from any one event, because what I've found is that trying to game things based on what I expect from an event and things like that always tends to be usually a nonlinear response. So it tends to operate very asynchronously from that. So just to kind of put things in regular world terms, what I'm looking at here on the chart, and just to walk you through, is that this extraordinarily linear move, and I'm just looking at the Dow index right now, is akin to having a water heater that you've got out there. And I try to put everything in terms that people can understand. Imagine if you had a water heater that never shut off. So the flame went on and it never shut off. What's going to happen? That thing's going to turn into a missile. It's going to go right through your roof. Okay. And so this is what we're seeing right now, is that all this consolidation that we've got in here is essentially like the flame is on, and this thing tried to go higher. It should go higher. It should go higher. From a pattern like this, this is as bullish as they get. It tried to go higher, tried to go higher. Okay. Can't get there because it's got this lead anchor down here. It's got this anchor down here of overhead supply. And I think what it's going to have to do is the pressure relief valve is going to have to kick on. And this is where I'm expecting us to pull into. It's not going to be that big. The expression that I use in a term like this is that nobody pukes at the top of a roller coaster, right? Nobody pukes at the top of a roller coaster. So I think we're just going to pull into a very small range here in that area and stay within there until we get this thing to basically recharge itself and get ready. I'm not calling for this market. I just think it's time for a little bit of a pause. That's about it.
Doc, you are destined to be a hell of an aviator, man, because I dug all those analogies. I'm stealing a couple, and I'm not giving you credit. So well said. Okay, AJ, how about you, my friend?
So I'm in the same vein as Doc, and again, the only variable I've got is the drop gap down on open and the response to basically governing by tweet and executive order that's happening right now. And so, but I see again that reversing by midweek. So that's why a little bit up, but I see that overall capped at around 2,315 and going sideways till we can get a new footing, going into a consolidation pattern and then perhaps leveraging up there unless something else uncertain happens. And as far as your question about what is the significance these days of these economic reports, I see it as well, lessening, and the monetary policy discussionings having less of an influence on the market, and we're seeing more of maybe fiscal policy rather than monetary policy taking the front, and then also just a whole bunch of populism. So that's where I'm seeing less response to economic reports, whether hard data or survey data.
Okay, love it. So what I'm looking at on my radar for the week is definitely the. I agree, AG. The macroeconomic data that we used to carry. Does everybody remember pre-2008 financial tsunami, where we used to hang kind of like beaks on the cross report? We used to wait for these jobs numbers to come out, or wait for a durable goods order to move the market. Now it's like, yeah, that came out at 10 a.m. Other than Rick Santelli, screaming, nobody really cares. I think we are going to be driven a lot more in this market by less on fundamentals and more on politics. So yeah, it'll be neat to see what Janet says. We know there's going to be 2 to 3 increases this year. We know that's going to happen. What's that do? Get in Goldman Sachs, get in the financials. When interest rates are high, stocks will die. When interest rates are low, stocks will grow. Yeah, we've seen these. The only little asterisk on the end of that sentence is financials. Financials have been in a jack in the box for the past 5, 6, 7 years. You stuff a Goldman Sachs, JP Morgan, all these guys. And then, I have a couple Jan 19 positions on in Goldman Sachs. We have members, one of our members traded 20 contracts on a long call diagonal on Goldman Sachs I put out in September. They're up $120,000. Goldman has been crushing it. When you have 4 people from Goldman Sachs in the cabinet and senior advisors, I think you have a little bit of a Goldman Sachs put under that position. And for that matter, Rex Tillerson with ExxonMobil. I don't think ExxonMobil is going out of business anytime soon. I digress. I'm not looking at anything this week like an old trader would in 2008, looking at durable goods or the Empire Fed or the jobs report, unless it's an outlier. I think everybody on this desk remembers the outlier jobs report. I forget when it was, 8 months, a year ago. Remember that one that was like an 85 grand print or 80 something? And everybody looked at that for like 15 minutes. The market didn't move for 15 minutes because I think everybody was looking on their screen going, is there a 1 missing? It's supposed to be like 100 and something. It was 85. You get one of those, and I think the market will care. Other than that, forget about it. So I'm really, believe it or not, glued to a lot of other stuff going on that's going to move this market this week. That's why I think we're oversold right now. And I think somebody showed their chart earlier. Let me just show you quick. We're back down to the. Let me share my screen real quick, and then we'll move on to the next question. Let me make sure I can do this, and let's just do that full screen. All right, so. Here's the rip your face off rally out of Trump. Here's a hope and change rally. Here's the rally on, hey, I hope this guy's not a lunatic. And then we level off and wait for the change. Well, last week we saw the guy do more in like 10 hours than we saw in 8 years. So there was going to be the change rally. And then, holy crap, comparisons to Hitler and Mussolini over the weekend. All right, folks, frothing at the mouth, calm down. So we're back to this. We need to see change potential liftoff point. So I think we're way oversold here. The only thing I'm going to be watching this week, except for some massive outlier economic number, and I like, everybody's got their own different sites. If you go to forexfactory.com / and click on the calendar up here, it goes through everything, and everything overseas too. I don't think there's anything. I do keep an eye on China, folks. A Thursday night while we're all snug in our bed, GDP out of the blue, that is good or bad, could move the market. But again, nothing really on this radar that I'm looking at that's going to back up my thesis of being oversold today and maybe catching a bid the next day. All right, very, very long answer, so I will give back my time, or whatever they say in Washington. So, John, let's move on to question 3. Actually, it's going to be question 4. So, Dave, if you could scroll for me, because I don't have my report in front of me, that would be stupendous. Or 4. Yeah, it's 4. So, John, super fast, supersonic trader and all that stuff, man, that I was trying to scribble down. Is the Trump rally going to continue? Why or why not? And what policies do you expect from his administration to impact the markets? And I got to be honest with you, man, I didn't think that an immigration thing with 150 people impacted would do this to the market. But John, what do you think with this Trump rally?
Well, I think with everything, like a lot of what the aforementioned guests have talked about, that trying to paint a broad, sweeping, monolithic brush on any market movement is complex and dangerous. So to say that this is a Trump rally or an Obama sell-off or whatever the case may be, there are just a lot of multivariate factors that go into determining what causes the market to go higher or lower. I think, does the rally continue? All suggestions are yes. I don't see any particular outliers that can destabilize this in terms of there is definitely some Trump risk premium. Is Trump, an 11 vol president, like realized vol's been trading like the VIX up until today is suggesting? I don't think that's the case. There's definitely some headline risk out there, but net, the idea of lower taxes, a Fed that's, moving at a gradual pace, is something that overall is conducive for equities to be bought and for people to own and maintain exposure. And as long as you have an environment like that, you sort of have to go with a longer term 100-year trend in equities, and that's higher. Pretty general, I know, but that's kind of what this comes back to sometimes. Keep it simple.
Well, no, exactly. Markets can be complex, and how do you battle complexity? Simplicity. I mean, that's at least the line we used in naval aviation. Landing aboard a boat is complex. Make it simple. Okay, Glenn, over to you, my friend. The Trump rally, it continues, doesn't continue, why or why not? And what policies do you think are going to come out of his administration to impact the markets?
Sure. Let me see if I can show a chart to illustrate a point, because I kind of agree with the consensus here, but let's see. Well, give me a second to pull this up. If I can get it, I won't waste too much time to. Can we see the chart I have or no?
Yep, got it now.
All right. So this is a daily S&P. I'm gonna just go back a year just to show a bigger view, and it's one of the things I've done to argue for what I expect is going to be a little further continuation of the rally. From an Elliott perspective, if you start, this is going back a little more than a year, January 20th of. Actually, yeah, just over a year, January 20th of 2016. This would be a 1, correction 2, a 3 of a particular degree. And then this bottom here, June 27, the end of Brexit, if we recall, okay, that's a 3. And then this diagonal I have shows a particular 5th wave. So one of the interpretations I have is that when you have between 4 and 6 5th waves, for those who are from an Elliott vantage point, a market will achieve a terminal point. So when is this larger degree 5th wave? And I think the count that I'm providing or presenting is what I consider to be of an intermediate count. The primary larger degree, the next degree would be a set of 8 waves taking place over a period of roughly plus or minus 4 years. So what I'm highlighting here are the intermediate, where you'd have about 34 waves in a span of a 4-year time period. So this last year, I'm showing the set of a cadre of 5 waves, again, constituting that intermediate count. If this is the end of the fourth and the start of a fifth, there should be 5 little waves in that. So this little top here is the little internal one of the larger fifth, the 2, the 3, all this consolidation up here, and then this triangular fourth into the Friday before the election, November 4. These vertical lines indicate time points on my chart that I've projected. Okay, so this little, if this is the start, the end rather, of a little internal fourth of the larger fifth represented by this diagonal represents another fifth, an embedded fifth, if you will. Think of Russian dolls in case one within another, a fifth within a fifth. The premise being, when you have 4 to 6 fifths embedded with one within another, 97% correlation, the market will achieve a terminus point. So if that's 1/5, and I won't waste time, but here's, okay, there should be 5 little fifths within this space starting on November 4, the Friday before our presidential election. Here was the election, the volatility, that big candle tail there. Okay, so this is a fifth within that larger fifth, and then you should have theoretically at least 5 little waves internal within that. So here's your 1, your 2, your triangular 4, and then the more recent fourth, and then what do we have? Lo and behold, a third fifth, a fifth diagonal within that fifth, within a fifth, and so on and so forth. I'll show you one more, and then I'll expand that out on the, let's see if you can see it a little clearly. So here you have my mouse will cooperate, a fifth within a fifth. This little fifth right here is the fourth. If you take it down one more degree, and then you'll see a little more micro structure, if I can. It's not going to cooperate, but maybe so. Maybe give it a chance here. If for some reason the system is slow. Okay, these are the internals. This is an hourly chart. So this is the bottom we saw last week, corresponding, because I drew it on the daily, it's not perfectly aligned, but this would represent the 4th, 5th wave within that are stacked one within another. And here's a 5th and a 6th. And you can see the little internals. That's perfect, almost textbook wave structure. 1, pullbacks, albeit slight correction for a wave 2. Your triangular 4, pretty standard. You see classic wave 3, market almost went vertical. And then this stuff up here is to the 5th. Now, again, we didn't, 22.96 and change, or 22.99 was the intra-period high. I'm juxtaposed to 23.16 that I generate via at least 3 different types. If you did, okay, so that's my argument that we are near the top, although not quite there. The fact that we've achieved these confluence of fifth waves, and doing so at an important, what I expect will be time point, suggests we're close to a top. I just expect the market wants to, will have a final extended fifth wave into the end of March. But that's a case to indicate kind of my opposite view for what I'm projecting for the end of the week. I think we'll be higher, but we're going to have further pull. This is just the hourly from last week, and I think this is just a little internal correction, fourth wave possibly, of what it will be another fifth internal, taking us to new highs by the end of the week. So hopefully that kind of is part of the technical reason. And then I expect the news and events and economic data to be, agree with that. But so if you did from the bottom on January 20th, a year and a few weeks ago, all the way up from, if that's the start of wave 1, up to this 3, and you took 62% of it and projected it here, you're going to get 2320. And then I got 2316 by some, here's your 61 Fibonacci. It actually comes in at 2315, but it's very close. And from a few other numbers, I get the 2320. So in that range between 2316 and 2310, aligning with this, here's the 3-day window, January 30th, and then February 1st, that I expect a turn to occur. So we shall see. So whatever has to happen fundamentally to serve as a catalyst or a driver to bring about what the charts, the confluence of both price and time are indicating, at least I have an indication as to what type of generic of news to look for that would be consistent with that technical view, is my thought.
Glenn, I love it. The way I trade here at TGO, it's kind of like if you've ever seen one of those radar planes flying around in the military called in AWACS, it looks like the radar dome at the top looks like a UFO landed on an airliner and is trying to carry it away. In the back, there's like 25 analysts looking at all sorts of things that if I told you, I'd have to kill you. The point being is a well-rounded trader, like Glenn alluded to, he not only looks at the technicals and he gave a great demo of those different levels, but he said, hey, but I'm also going to be watching the news or the fundamentals. So, and me as an options trader, and AJ's giving me a head nod, he's looking at volatility as an options trader. So you have to have what we in aviation call SA, situational awareness, man. Where am I in relation to space and time and the events going on around me? So, Glenn, that was a great discussion there. So, Doc, how about you? Trump rally continues. What's behind it, et cetera, et cetera, et cetera?
The rally continues, but we're going to see a more bifurcated market going forward. So, what I'm looking at here is the NASDAQ composite.
Hold on. No SAT words, Doc. Come on.
Okay, so here's what I would contend that from 2014 through halfway through last year, when we were doing this big shake and bake in here, okay, that is the equivalent. Markets can correct either through price or time. And so my assertion is that we basically had that big correction everybody was looking for over those years, and we went horizontally. And there's a lot of reasons for that, a lot to do with the Fed, a lot to do with negative interest rates, everything like that. We all know the reasons why, right? But what I'm contending also is that I think going forward is this enormous cup with handle pattern is going to, as well as, from a technical perspective, that's what it is. From a fundamental perspective, I think this is where all the change is going to be driven from, is in this area here in the NASDAQ composite. So over the next few years, I'm expecting the NASDAQ to, I don't know if it's going to double from here, but it's going to be part two of what we saw in the late 90s. So this is where I'm going to be putting all my focus going forward in here, because yeah, we've gotten a nice move on the industrials, we've gotten a nice move on most of the S&P sectors, but to some extent, I think there's only so much that we're going to squish out of those with some of the tax policies that we're putting into place, things like that. To your point, I think we're going to be getting into a rising rate environment that's going to be putting a lot of pressure on things. This is where the action is going to be again. So that's what I'm looking for. So the answer to your question is yes and yes.
Yes and yes. Perfect. AJ, lay it on us.
Okay, so I look at what's happening right now kind of like a sports game. For any athlete to be 100% at it, they play almost to the edge of the rules that they're given. It's how close can you skirt the edge without going over the edge. And what's happening right now is that nobody knows what the rules are. And because nobody knows what the rules are, people are playing very conservative. They're not playing to the edge of their game. And so I'm watching, I'm looking at all these beautiful S bars that have been happening, every once in a while an IZ bar. But then when you go down into the intraday bars, you're seeing a budding of the bulls and the bears throughout the day. This whole past week, at the end of every day, I've been seeing during the last hour of trading some gains, which didn't surprise me when on Wednesday we had the big pop. But I'm going to basically say that we've got maybe about 60 more days. They talk about the 100 days of newness that a new president has to get a lot accomplished before he gets kind of put into the same realm as what we've been talking about with all the economic reports and how they're kind of going to start being ignored. I think that the Trump rally comes to perhaps a little bit of a stall as we get into maybe the April time frame, because a lot of it's just worn off, and instead there's a lot of skepticism. What are the new rules? What do we do? And instead we're going to just play tight, and you're going to see maybe some upside breaks every once in a while when a positive piece lets the bulls win for a day or two, downside pressure whenever there's a piece there. But I'm personally going to be trading a lot of sideways strategies, a lot of theta decay strategies, and when there's clear volatility rush or crush, I'll be trading some of that. But directionally, I think that the rally is going to cool off. It's still going to keep going for about the next, I would say, 45 to 60 days. But sideways my way.
Okay, AJ, and obviously, like I said, getting to go last, I get to say just about all of you are right. Agree with everything that was said. I'm going to throw a little bit more out there. Yes, it absolutely continues. We're just taking a break here, and I am going to do a little bit of a victory lap here. Top Gun Options, we were one of the only, Jeffrey Gunlock, a couple other hedge fund guys. I can count them on one hand the number of people that both predicted a Trump victory and a Trump rally, and we were one of them here at TGO. The day or a couple days before the election, Citigroup, Hillary's going to win, and God forbid if Trump wins, there'll be a 5% correction in the market. The guy that made that prediction, I think, had a $75 million bonus last year and didn't hear from him after that, and I'm sure he's going to get something like that again. Completely wrong. Everybody. I speak around the country, giving keynotes and stuff, and applying, when I flew fighters in the Navy and how it applies to business. Short story long, I spent massive amount of time in the fall on the road talking to CEOs, salespeople, in just about every industry. I knew the polls were wrong, and I knew they were lying to us. I remember half the cocktail parties after the keynote or whatever, out in Vegas, people come up to me and, look to their left, look to the right and go, I'm voting for Trump. Like, if you said it out loud, you'd be hit in the head with a shovel. So it's not like I went out on a limb. I knew what was going to happen. Who was going to be better for Wall Street, Hillary Clinton or a guy who's got a tower 2 blocks away? So we nailed this. That's why I put on those Goldman Sachs trades. JP Morgan's got long and had a blast. This little pullback right here was exactly that, like a holy crap, did this happen? And then we got it up again. This sideways move, of course, in December, well, duh, it's December. And then this little pullback towards the end of the year was, Moose, Rocco, and Steve on the floor trading. There was no, it was between Christmas and New Year's, or Kwanzaa or winter solstice, whatever hell you celebrate. This was stupid. So we're kind of level here. We're pulling back right now after the holy crap. We have a politician who actually does what he said he's going to do. And oh my God, it's, he's putting people on trains. Everybody just relax. We're heading up again. The guy, for all the bluster about walls and this and that, the guy is going to make just lowering corporate tax rate, folks. What the hell is that going to do? It's going to bring that goes to the bottom line. Apple has $200 billion in cash sitting where? In like County Cork, Ireland. Bring that home. So lower tax policy, and then Steve Mnuchin. In full disclosure, Steve Mnuchin was a partner. He was a Goldman Sachs heavy and went to Dune Capital and worked. My sister and he were partners at Dune Capital. I've had dinner with Steve, know him really well. Treasury Secretary, he wants to gut Frankendodd. So if you don't think this rally is going to continue, you're nuts. And the same people, let me go back to this, the same people who right here 2 weeks ago said, sell the inauguration. It's over. This thing came way too far. Well, the same idiots who predicted that Hillary's going to win, and if Trump won, we'd all go to hell and the market would go to zero. Stop listening to the idiots out there, folks. I'm very passionate about this because a lot of my members in the fall were like, Whiz, you all right, man? You kind of, because for 3 months I knew we were being lied to, but we positioned our portfolios appropriately. Not only does the rally continue, there's still room to run in a lot of these things, man. I still would get in Goldman Sachs. Like I said, you have a put in the damn stock. It ain't going out of business anytime soon with 2 people in the cabinet and elsewhere. So the main policies that are going to help, let me get back on the freaking question. The main policies that are going to help, definitely tax and definitely lesser regulations, okay? And the fact that this guy likes to move at the speed of yesterday, not years. He's already, I'm reading reports that he's already given Paul Ryan grief. He's like, where's the tax relief stuff, guys? So I just think this thing goes. I'm not a dyed-in-the-wool Trump supporter. I don't want anybody to think that. As a business owner, and most of us are business owners on here, it offends me that the guy tries to browbeat businesses to stay in this country. You don't tweet or strong arm or stiff arm Mr. Trump. You lower those taxes, lower the regulations, do all the stuff you said you're going to do, and they're going to want to stay. Don't be a jerk. So for all of you who are like, oh, this guy's a off the reservation Trump supporter, I think the guy's a couple sheets, short of some things. But as far as us and making money as a portfolio manager, you got to trade the market you have, not the market you want. And a lot of these, quote, pros that make more money than I'll ever see in my life and could loan money to God got it wrong. They're not as smart as you. They put their pants on the same way as we do. And God bless America. So on that note, John, let's go top of the order, man. We have about 10 minutes left. I love with about 10 minutes left trying to steal a trade, man, because I'm a crappy trader and I like to steal trades from you guys and give them to my members. So what do you like right today, tomorrow, for a week? We're out to Jan 19, man. What's a good meaty trade you could give some of the folks that are listening to you right now?
Meaty trade, and I listen, it's still really meaty, and it's short soybeans. I think the soybean complex has a lot of bearish structure to it. Technically, we got a sell signal today, really nice one. I tweeted out last week to get short November soybeans. The November contract, which is trading about $10.05. Let me see here, $10.03 right now on it. So your short soybeans at 10.03. I think it's going to $9.50. This is about a 1.5 month, 2 month trade. Could happen a lot sooner, but stop above these highs, above 10.60 for November soybeans. And I love being short soybeans.
All right, short soybeans is John's trade there. Glenn, how about you? What are you looking at? What's a good one?
Well, up until last night, I had thought. Well, actually, I'm going to still go with it. Curiously, even though from an intermarket standpoint it might sound contradictory, by the end of this week, I want to establish long positions in gold. So we can have rising equities simultaneous or congruent with rising precious hard assets, metals in particular. Normally I trade silver when I trade the precious metal sector. I would do, say, something like a call back, a ratio back spread, sell a near strike and buy a greater number, 2-to-1 ratio, higher strikes in the gold market for various reasons. One other point, just following up to kind of contextualize it, Ed, I agree with everything you said, especially your point about don't follow the idiots. So yeah, as it refers to the broader equity market, I agree with everything you said. And what I like is when I have confidence and can buy into that belief, look at the charts. We've got a lot of that period from middle of December through the point where a week or two ago where we broke out was that base. The bigger the base, the bigger the extension once the breakout occurs. So yeah, in general, I agree, but I get nervous if I don't see across the board, meaning I want to see the confirmation from the chart. And currently we've got structure in that chart in the stock market for rising prices. And yeah, all of the fundamentals will come together, the tax reform, the regulatory reform, etc. We're going to see that come to fruition, I expect, over the next 2 to 3 months in the market. But my near-term trade would be long in the precious metal sector. And to John's point right before me, yeah, I don't anticipate major indications of inflation. So there's an interesting correlation between bean prices and inflation. So yeah, I would be shorting beans as well in one way or the other. But my trade for the week would be a long position in gold.
Guys, I don't even know the difference between a black or a pinto bean and Chipotle. So I'm an equity options guy, so I'm going to have to do some research on that. But I wrote it down because I love knowledge, man. Just like in Animal House, the statue of Emil Faber said, knowledge is good. Doc, how about you, man? Give us a meaty trade.
Well, I can't do beans either. I'm right there with you on the indices. So I'm looking at I'm actually looking at the diamonds. Again, my short-term forecast is that over the next month or so, we just start to increase the range of swinging around a little bit. We're not going to be in this little micro kind of sideways range like that. So we're going to swing around a little bit more. And for that, I just want to capture some value to the downside. So I'm going to be looking out into the 10 March options, and I'm going to be doing an in-out debit put spread. So I'm going to be buying a put in the money and financing that with one put sold out of the money. So something like a 200-198 put spread. You can buy that for about 86 cents a contract. So you're risking, that's about your risk, and you're looking to reward on there. Usually we're trying for about a 50-60% return on there. Very, very conservative trade, very easy to manage, very Greeks neutral. So that's what I'm looking for in the near term here.
Love it. Love trading delta neutral, Doc. Well done. And AJ, what's a good trade you could throw out to our hungry retail traders?
I've actually been looking at a company for quite a few years that just constantly is paying me money, and so I'm focusing on it. Either I'm doing some sort of condor on it or iron condor, or I'm buying a leap that's maybe out in 2019, and then deep in the money leap, and then selling calls against it, and that's Lululemon. Constantly is putting about 6 to 7% in my pocket every month, and so that's my trade of the suggestion is take a look at Lululemon and its sideways movement.
AJ, I love it, man. Our other places up in Boca Raton, and I've never seen a greater concentration of women who don't go to the gym wearing Lululemon than Boca Raton. And they also push their dogs around in strollers. Okay, for the Whiz fighter here, wrapping up, I got to go again with the Goldman Sachs trading out to Jan 2019. We can teach you at Top Gun Options how we do this, but I fly out as far in time as I can. Actually, let me start with this. The Captain Kirk trade is Brazil. We've been long the RSX, that's Russia. You got to be bullish on a guy that does whatever the hell he wants and might be buddies with Trump. So RSX and EWZ, look at Brazil, and not just because our director of client relations is from Brazil. This thing, they impeached, Rousseff. They're getting rid of the Petrobras scandal. Oil's recovering. This thing's been a hell of a trade for us for the past, year, and there's still room to run in EWZ. But folks, Goldman Sachs, hop in your F-18, your time machine. Go out to January of 2019. I put this on a month ago. It's up $5,500, and we buy a deep in the money 80 delta call. I don't buy a 1 delta call. It's way expensive. I don't buy a 0.5 delta call. It's at the money. It's a lottery ticket. I split the difference. I buy a 0.8 delta call, and then I buy a disaster put underneath it in case there's a disaster, but also to lower my haircut, my margin. And then each month or each week or each month, whatever time period I click, we end up selling front month upside calls and bringing in some scratch. So that's, like I told you, we have members that I did 5 contracts. Some did 10, some did 20. Some are up triple digits in this trade, 115,000 with one of my members. So Goldman Sachs is forget about it, man. Twinkies, Roaches, and Goldman Sachs will survive a nuke explosion, and most likely Goldman Sachs will finance the bomb and the recovery of that said nuke explosion. So, all right, guys, right on time, man. We got 2 minutes left. So, John, we're going to go top of the order down to AJ. How do we get a hold of you, John, and maybe take a look at what you do at Protein Trader? I
got one sort of thing, and that's this book that I wrote, The Global Macro Edge. I was in court for close to 9 years. Using this book and the money, raising awareness for service dogs to go to military veterans out there. We've donated 1 service dog already to an Apache helicopter pilot that fought in Afghanistan. Got him a golden retriever. Very proud of that. I make nearly all my living, pretty much all my living off of my P&L. So the big thing I'd say, just buy the book and support a veterans cause out there. And you can follow me on Twitter at John Netto. Yeah, that's it.
At John Netto. Hey, thanks, man. From a veteran here, I appreciate all of that. Thank you very much. That means a lot. So check that out, folks. Glenn, how do we track you down, man, and do what you do?
Sure. www.pacifictradingacademy.com. I haven't written the book yet, but I could just recently complete a chapter for an ebook. You can find out more about it at our website. Again, pacifictrading.com, and I present some opportunities for this year, 2017, in the chapter that I wrote most recently. So happy to be with you guys again. Yeah.
Awesome, Glenn. Thanks for coming today. And Skyhawk Doc, what do you got, man?
Hey, you can reach me at theotrade.com. Actually, we're doing a great little presentation tonight on pairs trading. And if you want to read anything more about what I think about the trading world and the space between your ears is hacking the Holy Grail, is my book. It's on Amazon. Back to you.
Hey, Doc, real quick. 5 of us know what a pairs trade is. Give me 30 seconds of what a pairs trade is for those folks who go, what the hell's a pairs trade?
30 seconds is you've got something that's going sky high to the upside. You've got something that's going sky low to the downside. You're diverging between the two. So basically what you're looking for is reversion back to the mean for the NVIDIA to come back down a little bit, and maybe something that's being sold off to come back up again. So you're in essence hedging the position against each other. You're just looking for reversion back to the mean on something that's gone, diverging by that big amount.
Perfect. Good analogy, Doc, especially since you're getting into aviation now. Is what? Oil goes to $100, $150 a barrel, short the hell out of the airline. So that would be kind of a Paris trade is, long oil, short airlines. So, all right, Doc, hopefully they check you out tonight. And AJ, how can we get a hold of you and what you do at Trading Trainer?
TimingResearch.com is where you've always been able to get a hold of me. And definitely in the next 3 or 4 weeks, I am going to be just mailing out some blog posts talking about exactly what you and I have been talking about, which is going far out in time, deep in the money, and getting yourself a call, protecting it with something, creating an oh crap move there, put, and then just selling either weekly or monthly premium trades to get that cost basis down. So I'm going to be going over that, and so I suggest people just go to TradingTrainer.com and sign up for the newsletter so you can follow up on my blog posts on that. It's not going to be any cost or anything like that.
AJ, music to my ears, man. Sounds pretty good. And me wrapping up, folks, you can obviously, my marketing department was small when I started 7 years ago. I went to Top Gun, so I stole it, TopGunOptions.com. And unfortunately, we did a huge full throttle launch last week where we got 50 annual members, and we kind of closed the doors. The only thing we have for the next month or two are test flights. If you're more, hey, Whiz, I'm new to options, or I'm looking into retirement or just conservative, you can take it's kind of a ski slope here. A beginner trial, a 2-week test flight. Intermediate is, I know what covered calls are or buying calls and puts. I kind of know what I'm doing. And then the advanced trial is for weekly options and folks that kind of know what they're doing. So you can just go to our homepage and click on one of these trials if you want to check it out. So, all right, guys, went about 2 minutes over, so that means I got to buy everybody a shot, unfortunately. So, David, let me turn it back to you. Thanks for letting me host, my friend, and hope to be back soon.
Yeah, definitely. Great show, guys. Just want to remind everyone watching, you please hit the subscribe button on YouTube to make sure you get updates on future shows. And be sure to go to TimingResearch.com so you can download any of the past reports or watch any of the past shows there. Be sure to join us next Monday, February 6th. Andrew Keene, Kim Kenny, and Rob Hanna will be back. And just want to thank my guests again from this week. John Netto of theProteanTrader.com, Len Thompson of PacificTradingAcademy.com, Doc Severson of TheoTrade.com, AJ Brown of TradingTrainer.com, and Matt Buckley of TopGunOptions.com. Thanks, guys.
Awesome, David. Thanks.
Take care.